An estate has two tax lives, and the EA exam tests both. Part 1 cares about the beneficiary, what they report on Form 1040 and when. Part 2 cares about the estate as its own entity, Form 1041, possible Form 706, and who can sign and act. Keep that split in your head, because many questions are really asking, who reports this? Estate tax and estate income tax are totally different animals. Estate tax is a transfer tax at death. Think what property moved because someone died. Income tax is what income was earned after death by the estate. On the EA exam, they love wording like death tax or inheritance tax, but the key is, estate tax is not an income tax, and it uses different forms and thresholds. A decedent's estate is created at death. At that moment, you now have a separate legal entity holding the decedent's assets until they're distributed. Because it's a separate entity, the estate generally needs its own EIN, just like a business would. That EIN is what you use for estate bank accounts and for filing the estate's income tax return, Form 1041, when required. Probate is the court-supervised process for administering the estate, and state law controls whether probate is required. If there's a will, the court appoints an executor. If there's no will, the person died intestate, and the court appoints an administrator. Both are personal representatives with authority to act for the estate, collect assets, pay debts, and handle tax filings. For IRS purposes, you'll see executor and personal representative used loosely. The IRS often calls anyone filing for the decedent a personal representative, even if the title is administrator. But here's the exam critical point. The IRS won't just take someone's word for it. To act before the IRS, the representative must provide documentation, like a court appointment order or a certified will. A simple statement is not enough. Zooming out to the big thresholds, for estate income tax, the estate gets a tiny exemption, $600. For estate tax, you're thinking Form 706 and the basic exclusion amount. In 2024, that exclusion is $13.61 million, and if the gross estate is below it, Form 706 generally isn't required. Also know the deadline. Form 706 is due 9 months after death, with a 6-month extension on Form 4768. One more exam favorite, portability and DSUE. If a spouse dies and didn't use all their exclusion, the unused amount can transfer to the surviving spouse, but only if the executor makes a portability election. That election is made by timely filing Form 706, even when the estate is under the filing threshold. That's the twist. You may file Form 706 just to preserve DSUE. Before her death on January 1st, Natalie ran a bridal dressmaking shop and used the cash method. At death, a vendor owed her $20,000 for a dress. The vendor paid on March 1st, making the check to the estate because probate was already underway. Her son Ethan is the sole beneficiary, but the $20,000 was not distributed before the estate settlement. Where is the $20,000 reported as taxable income? Think about it. It's reported on the estate's income tax return, Form 1041. This is income in respect of a decedent, earned before death, received after death, so it does not go on Natalie's final Form 1040. The entity that actually receives it reports it. Here, the estate received the check and didn't distribute it to Ethan, so the estate reports it. The tempting wrong choice is the final 1040, because the work was done before death. Derek earns $35,000 in wages and doesn't own a business. During the year, his wealthy Aunt Marjorie dies, and Derek is a beneficiary under her will. Later, the attorney sends Derek a $9,000 check and a Schedule K-1 from the estate. Where should Derek report this income on his return? Consider the choices: Schedule E, Schedule C, tax-free, or Schedule D. Think about it. He generally uses the Schedule K-1 information and reports it on Schedule E of his Form 1040. A K-1 from an estate or trust flows through to the beneficiary, and Schedule E is the usual landing spot for that pass-through reporting. A tempting wrong answer is Schedule C. because the estate owned a restaurant, but Derek isn't operating the business. He's receiving beneficiary income reported to him on a K-1.